Why do you think people overcomplicate investing? My theory is that it's easier for stockbrokers, banks, or even people on social media to sell you something, right? I don't know how to open a brokerage account. I'll just pay someone to do it for me. I don't know how to pick investments. I'll just pay someone to do it for me. I don't know how to invest. Investing isn't for people like us. It's not for people like you and me. It's for the super wealthy, the wealthy who can afford brokerage, stockbrokers. It's for the wealthy who can afford money managers, financial advisors. And because we can't do this and we can't afford it, therefore it's not for us. And part of the reason that people overcomplicate really basic investing stuff is for that exact reason. If I sit down with you and I start talking about 3 times leveraged ETFs, goes right over your head. And you're just going to go, you know what? I'm not going to be the kind of person who's going to be able to have an investment portfolio. Forget it. Investing just isn't for me. They want your money. That's it. That's all they want. That's the reason that they make it so overwhelming and so confusing, but it doesn't have to be that way. And in fact, it really isn't that way. So my name is Kenneth, and I've been teaching people on social media how to trade stocks and invest for the last couple of years. Prior to that, this whole social media thing, I've been a self-employed, self-taught stock trader. I read a couple books. I started trading 13 years ago. And prior to that, I was an investor all on my own. I just started looking around and going, hey, everyone has, in high school, everyone has an iTunes account. Everyone has the original iPod. I started thinking, maybe I should be investing in these companies. Maybe I should be buying stock. I like McDonald's. Maybe I should own what I like. Doesn't always work out, but it's a good it's a good stepping stone. It's a good foundation to start thinking in terms of like, where do I like to shop? What do I like to buy? Maybe I should invest in that. But for the average American, the average beginner investor, or even just the casual investor who is very successful and just doesn't care about a stock market portfolio, the easiest thing you can do is going to be the 3 things that I'm going to go over in this video right now. And I will be putting pictures in this area to show you more in-depth stuff. So maybe I should give a little scooch so I have more room over here. The very first thing I would do is I would get a broad market S&P 500 index fund. Think of it in terms of a basket. So there are 500, there's actually 503 or 5 stocks in the S&P 500 currently, and invest in all of them. Now we can get really into the weeds and talking about passively managed funds versus actively managed funds, but this is a video for beginners who don't care about any of that. A passively managed S&P 500 index fund that just tracks all of the stocks in the S&P 500 on average has a historical rate of return. In other words, it goes up about 10.5% per year on average. So there's going to be years where it goes way down. There's going to be years where it just goes up a little, years where it goes up a lot, and then they take that number and they get the average. That is a good, solid foundation for most people. That's the very first thing that I would do if I was a new investor. 20 years old, open an S&P 500 index fund. Maybe it's in a Roth IRA if you have a job, if you have earned income. And I would just start putting in as much as you can. You'll be a millionaire by the time you retire. Here is some basic math that shows you what just the minimum, $100 a month will get you. And I'll do another one that shows you what $200 a month will get you over a 30-year period. So if your goal is to retire by the time you're 60 and you start in your 20s, you'll hit that number way earlier and you'll invest way less. So I'm also going to show you what it looks like if you start late. So if you are 40 with the goal of retiring when you're 60, so 20 years, you're way behind. That's the first thing I would do, and it's sufficient for most casual investors and people who don't care. The second thing that I would do, if I started to get more interested in the stock market, is I would buy something like a Schwab high-paying dividend ETF. This dividend ETF invests in, I believe, 100 companies. And I'm going to put some statistics right here on the screen. As long as you're enrolled in something called DRIP, or Dividend Reinvestment Plan, it's going to be taking all those dividends that you're getting every quarter. Some of them, like the real estate trust that I'm going to go over next, pay monthly. And you are going to be building and building and building. It's a snowball effect. So you're going to start with a small amount, and it's just going to start reinvesting and reinvesting and reinvesting, and the fund will appreciate over time as well. So you're going to not only be getting the dividend. This is a mistake I see a lot of people make in my comments on TikTok. They say, 6%, 5%, that's nothing. But they're neglecting the fact that the dividend isn't the only investment. The dividend is like a bonus. The asset, the stock, also appreciates over time, hopefully. The very last thing I would do, the third thing I would do, is I would invest in something called a real estate investment trust. Realty Income, or O, which I'm going to put right here, is like the standard. There are lots of other real estate investment trusts, and there's way more information on them. I have a full REIT, that's what it's called. I have a full REIT playlist on my TikTok channel if you're interested. But generally speaking, O is like the standard. It's pretty safe. They invest in a lot of companies that you already know. I'm going to put them right here. Real estate investment trusts typically pay monthly. So you're going to be getting dividend income every single month. Now, you don't want to take that cash that you're getting from your real estate investment trust and use it to pay for coffee and dinners out and groceries. You're young. You want to take all that money and put it back into the investment over and over and over. So you can start with 100 shares, and then you'll have 101, 103, 105. Maybe your grandma gives you $500 for Christmas, and you use that money to buy more shares. So now you've got 150 shares or 110 shares, whatever. And it just keeps building and building and building. Before you know it, you'll be at a point where you can retire off of your dividends. In other words, stop reinvesting the dividends, get that cash into your account and use it to pay for your expenses. Use it to pay for your lifestyle. Use it to quit your job early. That's the goal, right? Everyone talks about the goal is to have a nice car, but that nice car only gets you to the job that you hate. It keeps you tethered to the lifestyle that you're so desperate to leave. But we always buy these nice cars and these fancy clothes and watches and shit like that because it makes us feel better about our situation. So it's like a never-ending cycle. So if you can break that cycle and get a used Civic and not worry so much about the fanciest clothes and the nicest gadgets and the fanciest tech, you can retire way earlier because you'll be taking that money that you're pissing away on stuff and funneling it into your investments. So if you thought this video was helpful, you know what to do. Hit the bells, hit the subscribes, hit all the notification things. Thanks for watching, and have a good day.